Hello, everybody. Welcome back. Ted, thank you for coming on the podcast
Yeah, thanks
today.
for the invite. This is great. I love it.
Yeah. So today's topic is super exciting. We're talking about real estate and
I
taxes.
always tell people I'm a lot of fun to talk to at parties.
Yeah, no, I mean, in all seriousness, like it's an important topic to cover, right? Because, well, we all pay taxes. Hopefully, if we don't, then that's a different kind of topic for us to cover. Um, And a lot of people know that there are tax implications to owning, selling properties, et cetera, but they might not necessarily know some of the nuances. And we'll get into some nuances, but it is complicated, right? Tax code is exceptionally complicated, and we're not going to have a conversation about how maybe the whole taxes system needs an overhaul. Not today.
Very true. The book is very
But
thick. The
anyways,
code is very thick.
yeah. So trying to get people through it, but just so people know kind of why I identified you as a guest today. So we've met in the past, but you run a practice in your home. And for people who don't know, maybe I've probably said this on the show before. My dad actually ran a tax practice out of our home growing up, and just recently retired a couple of years ago. And then when I found you, I also found out that you're very into baseball. My dad's very into baseball, and actually, he was the one who prompted me to start playing
Oh,
softball through
nice.
college and everything. So, yeah. So it's anyway. I felt like a kinship with you, and I also think that there is an authenticity to you. So people will hopefully take this information, but also feel like you're a really good source for all of it, just because you're coming from it as a, I don't know, like a normal
Yeah.
person, right? You're not a
I'm a little
tax
bit of a
robot.
tax geek, but yeah, my office is in my basement here. My kids come home from school and I'm here, and that was kind of the dream. Like, I don't know if you ever saw Growing
Yeah.
Pains as a kid, but Mike Seaver's dad worked in the
Mm-hmm.
house and he was there when Mike came home from school. That was always my dream.
Yeah. 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 All right. So at the very least, we know
Yeah.
you're approachable, right? So the thing I really want to start with today is in the beginning, when people are thinking about buying for their first time, they've likely been renting before. And a common thing that, parents, realtors, whoever will tell these people who are considering it is that you really get a lot of tax benefits of owning a home versus renting. And so I'm wondering if we can just start by talking about what the pros are, maybe if there's some cons, I don't really know, but what happens and the implications of
Yeah, it's
owning.
it's interesting you bring that up because people will call me wanting tax help, and I always kind of start the conversation with, do you rent or do you own? And if they tell me they're renters, like, there's not a whole lot I can do for them. There are some tax savings as an employee that, you can contribute to retirement. But really, the tax code opens up once you become a homeowner.
Yeah. I mean, maybe we can run through the list of like how the tax code can benefit a
Yeah,
homeowner. I know like the first one people think about or know really back, but I'd say the first two are like property taxes and mortgage interest, but there's really a long list. So maybe you can just take us through all of
yeah,
them.
no, that's a great start. One of the interesting things is, you know, when you buy a home, you get a mortgage. The mortgage interest you pay is deductible, not the principal. So, maybe your full payment is $2,000 a month, and of that payment, $1,500 is the mortgage interest. Only that $1,500 is deductible, but it's still, a pretty hefty portion, especially at the beginning. As you pay the mortgage over time, the interest decreases and the principal increases. So your mortgage interest deduction decreases over time, but it's a huge deduction. Like you said, real estate taxes are deductible, and then as you're doing things to the house, putting in new windows, or I don't know, maybe the house needs a new roof. These things are added to what we call the cost basis of the house, and the cost basis of the house is what you paid for it, the day you bought it. And so you're always trying to increase that cost basis as you own it. If you own the house over 30 years, you're probably going to put in probably half of what you paid for the house originally just to maintain it and keep things going. So um, at the same time, you're building equity instead of paying a landlord rent. Now you're essentially paying yourself because you're putting money into the house. And so you're building equity, and then you have a nice asset that you can use for all kinds of purposes down the road, borrowing against it to start your own business, for example, or, things like that. So it's just
Mm-hmm.
nice as an asset. you're building money for yourself. You're increasing your personal wealth instead of putting it in some landlord's hand.
Yeah, I mean, this is like our 54th episode, I think. So anybody who's regularly listened to this podcast, like everything, kind of these topics start to kind of bleed together, obviously. So, taxes obviously are leading into kind of personal wealth, and if you have, somebody who's working with you on basically managing your money, a lot of this, I mean, this is hand in hand for sure. So yeah, I mean, I think it's interesting that the next one I'm going to say is a whole topic we covered, which are tax credits from energy efficient improvements. So we talked about improvements in general, and I did a whole episode on getting solar in the area. So I mean, so I didn't say this at the beginning, but obviously I'm licensed in DC, Maryland, and Virginia, and there are different tax codes per state, and then there's obviously federal. So we might not be able to speak in specifics today about what jurisdiction has what. But I mean, as far as energy efficiency improvements, do you have anything to kind of comment on that?
Just like you said, the big one these days is solar energy, and basically 30% of what you're paying to purchase the product and have it installed is a tax credit. There are other things, energy efficient improvements such as new doors or new windows, a new furnace or a cooling system. There's all kinds of credits that are available. They're not as big on the items like the doors and windows as they are for something like a new boiler or a new cooling system or the solar, but there are still some things out there, and just something to be aware of as you're making these improvements. Especially in the spring, everybody kind of gets out and wants to do things. They've been in their house all winter long, and they see where do we need to have improvements made. So yeah, just things to keep in mind, that anything you're doing to, I don't know, make your house nicer or better, there's potential in there that there is a tax credit available, or maybe a deduction somewhere along the line. So yeah, always consult with your tax advisor and find out, hey, maybe there's a little more benefit in this than I realized.
Yeah, I mean, when I went into this episode, by no means was I thinking that I was going to plug working with an accountant for the record. And I've never actually worked with like a big, like a TurboTax kind of thing. So I can't really speak to what it's like, but I was always under the impression that working with somebody one-on-one, you're really going to delve into the specifics of this so you can truly, really get somebody the best kind of, I don't know, deal possible, or, the pay the least number
Right.
of taxes, for what you have.
Yeah, that's
So I guess it is.
yeah. Well, I mean, it's kind of what we do, and a lot of times I'll tell a client like, "Oh, hey, that conversation, the money you're saving in that conversation paid my fee."
Right. Okay. Well, anyway, your information will be linked in the episode, but
Yeah, I didn't mean to make it a sales
that's
call
not the
either.
point.
Yeah.
Okay. So is there anything else as far as tax implications for when you're owning versus renting? We already covered it. Renting, you really have no positive tax implications, but anything else for when you own a home that you should be aware of or
Yeah,
considering?
I always tell folks, especially before they end up selling the house, keep a list as you're doing things to the house. Keep a list of what the improvements are, how much you paid for them, and what the date was that you did the improvements, so that when you go to sell, you've got all these records ready to go. Often I'll tell people as they're or before they sell, just walk the property. Go from the street to the end of the property line and write down everything that you can remember doing to the house. But if you're doing it, if you're keeping this list as you own it and as you're making the improvements, then you don't have such a heavy lift when you go to sell. The other thing to remember is, once you own the property, any improvements or anything that breaks, it's on you to fix. When you're renting, something breaks, you call the landlord and they send, somebody out to fix it. It's just, that's the one negative of homeownership is, yeah, things break and you got to get them repaired.
Right. Kind of like owning a car, or really owning any other big thing. It's
That's
your
right.
responsibility to keep it up and running. Okay, so what we often see then is we can kind of get into if we were to sell this property, right? So we can start talking about the exclusions and gain of sale, blah, 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 blah. So let's just say that somebody has lived in a home for 10 years and they want to sell it before buying the next property, or simultaneously, whatever. Then maybe you can talk to people about how taxes in that situation kind of add
Yeah,
up?
it's funny because I'll get calls about that. Like I sold my home, and at closing I received $300,000, and that's what went in my bank account. So what am I taxed on? I'm like, well, that's not it. What we're looking at when you sell your house is what'd you sell it for? What's the sales price? What did you pay for it originally? And then what were the amount of the improvements that you made over time? And that's it. Those three things are all we need to figure out what is going to be your taxable gain. So once we know what that taxable gain looks like, then we can look to the tax code, and there's a section 121 that allows for an exclusion. If you've owned and occupied the home for 2 out of the last 5 years, and you're a married couple, you can exclude up to $500,000 on that gain from tax. If you're a single person, you can exclude up to $250,000 if you meet the test, the ownership test. And so that's, it's a huge way. Again, you're just building wealth. If you've owned the home, it's appreciated in value. You can sell it, and maybe a lot of it will be tax free. And that's why it's also very important to keep those records on the improvements, because maybe those improvements will put you in a situation where that gain is under 500,000, and then you walk away from the sale not being taxed on any of it.
Yeah, I mean, that's certainly a big one, because in this and like this environment, the cities we're talking about, DC, Maryland, and Virginia, you can often have a fairly big gain. So if we're talking about a smaller market, these numbers can, I don't want to say be irrelevant, but you're not really butting up
That exclusion.
against going over these numbers as much. Whereas here specifically within the
Yeah.
Beltway, I mean, these numbers are very
And
important. So it's important to keep track of everything so that I mean, listen, nobody wants to be taxed more, right? So that you're so that you're having the least negative tax
yeah,
implications
and
possible.
especially here, if you've lived here for a long period of time, the market
Mm-hmm.
here has been tremendous over the last 10 20 years. So yeah, I see people all the time who are, I can't believe it, I'm actually paying tax because my gain is over 500,000. Like, yeah, consider yourself lucky, because you're making a great deal on the property. You're going to get taxed a little bit, but you still have that big $500,000 exclusion. So yeah,
Yeah.
it's not unusual here to actually have people facing that tax.
Yeah, no, I mean, I've got buyers who just offered on a place that was purchased in the very late 90s for, I think, $500,000, and it's going to sell for like
Yeah,
2.5.
it's not unusual.
No. Anyway, okay. So are there any exceptions to this section, to
Yeah, so
121?
there's a couple other ways that you can uh, get the exclusion even if you don't meet that ownership and occupation test. Um, there's things like if you change your workplace, essentially if your job changes and you have to move more than 50 miles away from where you were originally driving to work, and you need to sell your house because you want to move closer, you can qualify for the exclusion. There's a health issue. If you have moved away so that you get closer to a hospital or a doctor that provides good treatment, there's an exclusion eligible. You're eligible for the exclusion for that. And then there's other things. They say unforeseeable events, such as like a natural disaster or something. It sounds funny, but here, even just the land that people have here is valuable, and that may still put you over the that $500,000 mark. So just know that there are other unforeseeable events. That it's kind of tricky. I started reading up on it, and there's like a whole long list of unforeseeable events. But the main thing that kind of stuck out to me was like the natural disasters, or like a fire, or something completely crazy.
Sure. Yeah. And I think one that I saw was for if you're State Department, right? If you have to move and you're out of the country, then living in the home 2 out of the last 5 years obviously can be completely out of your control. So that's an exception
Yeah,
as
so they
well,
give like
right?
a suspension of that 5 year test, because, yeah, and I think the suspension allows for 10 years of being outside the home on a work assignment, like, yeah, like somebody with the State
Yeah.
Department or something along those lines, or military, same kind of
And
thing.
that yeah, and that's huge in this area. So I think it's important for people to know that. I've got a client currently who's out of the country and selling her place. And I put her in touch with, gave her some accountant names, because that's
Yeah,
something you need to understand. And if you just look up the rules for a U.S. citizen who's living here, they might not apply completely.
Don't file your own tax
Yep.
return in that situation.
Yeah, no TurboTax for you. Okay, so there's another plug. So let's say you didn't sell your place and you decided to rent your home out. This is the case, this is where I'm at. I've talked about it a million times. The first place I bought is a lovely 1-bedroom, and I decided to rent it out. We can talk about what happens on my taxes now, but we can also talk about what happens when I go to sell, because I have not lived in it 2 out of the last 5 years.
Let's start with just being a landlord. I did the same. I moved out here in 2008. I still had a condo in Chicago, a 1-bedroom that I rented, and I kept it for about 8 years. And it's funny, I had a professor at American University who specialized in real estate, and I took his class, and he loved it. His whole life was nothing but being a landlord. He owned a bunch of properties, and really kind of like made me buy into the fact that being a landlord was great. And the reason it's great is because all those things that we talked about being deductible previously, mortgage interest, real estate taxes, those things are still deductible as a landlord. But now you get even more deductions, things like insurance, condo association fee, homeowners association fee, cost for repairs and improvements that are needed that are minor. Those things are all deductible on your current year tax return, and that offsets the rental income you're receiving. And then there's the hidden deduction that nobody ever sees because you don't actually pay it out of your pocket. It's depreciation. And the way depreciation works is we say, what was the cost of your property? And then we take 1/27th of that as a depreciation expense on an annual basis while you're a landlord. And that usually puts people into a situation where they're generating a tax loss on the property. Even if you're charging more rent than what the mortgage is, you're still generating a loss. The loss is a little bit tricky because while it looks like you're going to take this loss on your tax return, if you make over $150,000 of income, that loss doesn't get used in the current year. It gets carried forward into the future when either your rents are high enough where you're generating a tax gain, or you sell the house. And at that point, then the loss frees up. The one trick with depreciation, though, is you have to recapture the depreciation when you go to sell the property. And that throws people off. They're like, well, that was an expense I had to take. Why did I ever take it? You have to take it. The government mandates it. If you don't take it, the IRS is still going to figure out what the depreciation was that you should have taken, and they're going to make you recapture it even if you don't take it. So,
yay, IRS! We love
so
them.
take that depreciation. It's important. Now, if your income is under $100,000 and you're a landlord, you can take up to a $25,000 loss annually on the property if it's generating that kind of a loss. And that's a great deal. We call that like the mom and pop loss. When that's the only thing you're doing, maybe you're retired and the only thing you're doing is you have rental property and no other source of income. It's great passive income then, and heck, it knocks your taxes down.
Yeah. Okay, so then let's say we haven't lived in the property. Well, in the case of you, right?
Yeah.
Or me, you haven't lived in the property for 2 of the last 5 years, and you want to sell it. Maybe you want to buy something else. I'm kind of getting into the next topic. Let's
All right,
cover that.
let's just talk about selling without buying a new property. We can talk about that next step later.
Perfect. Let's do that.
So when you're a landlord and you sell the property, again, the gain is going to be based on what your sales price is minus what your cost basis was. And as you're taking the depreciation expense annually, your cost basis decreases by the amount of that depreciation. So your gain might be a little bit bigger now because you haven't owned and occupied the house for 2 of the last 5 years, and so you're going to be subject to gain on the sale. The depreciation recapture comes in, that's taxed at ordinary income, but that loss that you've accumulated over the years that's carried forward, that frees up. And so typically the way the tax code was meant to happen is that recaptured depreciation and that carry forward loss are supposed to kind of cancel each other out. It doesn't always happen that way, but that's kind of what it's there for. So you're going to pay tax on the difference between the carried over loss and the recaptured depreciation at ordinary income. And then you're going to pay tax on the gain, the difference between the sales price and your new cost basis.
Got it. Okay.
A lot of math here. I need some charts.
No. I mean, before the show, we talked about how this could get very like, A plus B equals C, minus D, blah, 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 blah. And we're not trying to make anybody confused here. We are actually trying to speak in broad kind of general terms, because it can get, what I said in the beginning, this gets rather complicated. So, hopefully people are at the very least kind of understanding this if it's getting complicated for them. But, again, talk to somebody and they'll help you out. But, okay, so if that's that, and let's say I want to sell my property and buy something else, what kind of rules are different? Well, how does it differ between what we just talked about, which is just selling it and keeping the cash, versus wanting to use that cash for something else?
Yeah, it's a great question, and actually had this with a client that kind of blew my mind with what they were doing, but it was totally legal and legit. So it's what you want to get yourself involved in then is a like-kind exchange. It's also known as a Starker exchange. Starker is some guy who developed this in the tax code, so he gets all the credit.
I will tell you, by the way, when we started planning this episode and we were talking, I read that to my dad. I was like, do you think we're missing anything else we should cover? And my dad actually never heard of that, a Starker
really?
exchange.
Yeah.
Nope. So I don't know, like, if is that a common term?
Not really.
I guess.
I think,
okay.
Yeah, the people in the industry who specialize in these things, I think that's how they refer to it.
Sure. Yeah. I thought it was funny. Anyway, go on.
No,
Sorry. So 1031 exchanges or Starker.
1031 Starker, like kind, it's all the same terminology. So in that prior example where we had the taxable gain when we sold the rental property, the like kind exchange says if instead of just selling and walking away and going about your life, you decide, oh, heck, I want to do another rental property, you can postpone the gain on that sale if you take the gain and put it into a new property. Again, it has to be rental property, it has to be like kind, so it has to be of similar use. It can't just be the house that you're living in. But to do that, you really need, they call it an intermediary, a 1031 exchange intermediary. And that means, you have to go through this process of, you have to identify a new property that you want to buy, and then within a certain time frame, and I think it's 180 days, but don't quote me on that because I haven't looked at this in a while. You have a certain time where you have to identify a new property, and then you have another deadline where you actually have to buy the property to qualify for the exchange. And the intermediary is there to hold the gain that you had from the sale of the prior property. They hold the money until you use it to buy the new property. And if you decide, oh, heck, I don't want to buy anything, then the intermediary just gives you that money back. But you definitely have to have an intermediary involved in the transaction. But again,
you definitely have to have, you have to have somebody involved in the whole thing. I took a 1031 exchange kind of class, and there are multiple deadlines and timelines that have to happen. So I would say for anybody who wants to do this is the one where you truly, truly, truly need to talk to somebody beforehand. It can't be a like blasé, like, oh, I'll figure it out kind of thing. It's not that. I had a really tough conversation with somebody who wanted to sell a property in New York and invest down in Maryland. And I mentioned this and he was like, what? I was like, oh boy. Okay. Like, you really need to chat with somebody and understand how this is going to work before we go out looking for properties.
Yeah. And you can't just do it on your own.
Yeah, it's complicated.
You can't just say, I bought and sold, and then I bought the next one. You have to have that intermediary involved.
Yeah, you do. And another thing that's really important to make sure that we say again, I think slowly for everybody, is you cannot take that money and roll it into your primary residence. It has to be that like kind. So, if it is a rental property, it needs to be another investment rental property. I'm assuming it's the same for is it the same for a second home, like a vacation home?
I think that's a different law altogether. Yeah.
Right.
But yeah. Yeah, it's got to be like kind, and yeah, it has to be like business use or rental use, I believe. So, yeah, the rules get tricky. Definitely, you need to consult somebody who knows what they're doing and won't screw up the transaction, because you don't want an intermediary who is new. You want somebody that has experience and can walk you through the process. Different
Yeah.
states, yeah, you can
Yeah.
certainly, buy property from one state to another. I had somebody in Arlington buy a property in Sedona, Arizona, and they absolutely are thrilled to death with it. They get out there to visit the property every once in a while. And that's another thing I should mention as a landlord that my professor always preached to us was, if you have rental property and you're traveling and you're looking to buy new rental property while you're traveling, well, now that trip becomes tax deductible, at least some portion of the trip, but you got to make sure you document everything you did. Like, hey, I own this rental property here in Arlington, but I want to go down to Florida and look for investment property down there. Document the flight costs, the days that you traveled, the days you actually met with a real estate agent down there, and the cost of the hotel if you had to get a rental car, those kind of things. And a portion of that trip can become tax deductible, even if you don't buy. If you're just scouting the area. So it makes traveling a little more fun once you become a landlord.
Well, I mean, again, I'm not trying to trash the tax system too much. Actually, I don't care. I will. But the my taxes are so complicated because, as a real estate agent, you're technically self-employed, and we might go, you're driving a lot, and you're supposed to be keeping track of logging every mile you drive that's for work. And, there are apps for it and everything. And I'm always basically yelling to my dad, not at my dad, saying I'm going to the grocery store after I do a showing, am I really supposed to be calculating that? Anyway, it's ridiculous. But yes, if you are extra organized, then what you're talking about, writing off the vacation or the vacations, the looking for new properties, then that can work. But I mean, really, what it comes down to is if you're audited, that's when you would have an issue potentially.
Exactly. Sorry.
So anyway, well, it's okay. Your phone's ringing, and actually, we're at the really good time to end. I think we've covered a lot of really great stuff. Unless you have
just
some
one
final
thoughts.
Absolutely.
Everything we talked about here was if you're not a real estate professional. The rules are a lot different for real estate professionals when it comes to rental properties. But for just the average Joe who's just kind of dabbling in it, I think we covered everything pretty well.
Yeah, I mean, this show is supposed to be, I'm sure there are realtors who listen to it, but it's supposed to be for anybody who's not in real estate and trying to learn about really anything tangential to real estate. So, so I think that's fair. But, again, if anybody has any questions, make sure you reach out to either who you're currently working with, or if they're interested in talking to you. Your information, like I said, is going to be in the show notes here. But Ted, thank you so much for coming on, for making this, I think, a manageable topic for things for people to understand and at least wet their whistle when trying to research this stuff. And hopefully maybe some people will.
Yeah, no, Alison, thanks a lot for the invite. I love the format and really appreciate it. This was a lot of fun for me.
Great. Okay. We'll talk to you soon.